The sell-off continues. 30 minutes until the start of cash trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is on assignment, and Bloomberg Open Interest starts right now.
Coming up, Obliteration Day Part 2. Trump's tariff wrecking ball continues to hit every corner of the market. And a hot jobs report offers some relief to investors. Fed Chair Jay Powell takes the mic today. Plus, China retaliates with a 34% tariff on the U.S., even after President Trump said he's willing to cut a deal for TikTok. Katie?
Let's put it all together and take a look at how it's happening in markets right now. The S&P 500, which we're not looking at, but we should, because, boy, it is just an absolute wipeout. But we'll take a look at these stocks first. China-related stocks leading the drop, but I want to take a look at the futures because the S&P 500 down by over 2% right now. Remember, the index fell 4.8% yesterday. That was its worst drop since 2020, which certainly tells you something. And that selling momentum continuing today, even in the wake of that jobs print. I also want to take a look at 10-year Treasury yields. We were starting yesterday closer to 4.10%, 4.1%. Now we are well below that 4% level, and that rally just continues to build, currently down about 9 basis points. And I want to take a look at the VIX as well. We reached 45 in the pre-market. A lot of volatility being expressed. Some of it is draining a little bit right now. We're back below 40, but still trading with a 37 handle, Matt Miller. And we were trading in the 30s, around 30 this time yesterday.
Yeah, I want to go back to the board you had up previously because it strikes me if you take a look at those stocks that you were looking at, the single stocks, they represent individual sectors that are all getting hit very hard. You had Nike up, right, which represents retail. You had energy firms up like Occidental Petroleum. There we go. And you had banks represented by JPMorgan. All of those moving down 4 to 5% in the pre-market. As I said, banks are closely watching the labor market and its impact on interest rates. The U.S. added 228,000 jobs compared to 140,000 in the estimate. So blowing it away. That is a very hot print. Let's bring in Bloomberg's international economics and policy editor Michael McKee. Mike, is this the Biden economy?
Well, it could be a hangover from the Biden economy, yes, but I guess Donald Trump was president during February, so he can take the credit for it, although I'm not sure if he wants it right now, given the way his policies are going. But anyways, as you mentioned, 228,000, much stronger than anticipated. Now, 20,000 of that was the return of grocery store workers who were striking in Colorado, so not quite as impressive. And the February number revised down to 117,000. So major disappointment now for February compared to what we thought it was, 151,000. The unemployment rate goes to 4.2%, but all of that change, it's only 13 basis point change when you look out to 3 digits in the unemployment rate rounding issue. All of that was teenagers, so it may have been something around spring break. Men unchanged in terms of unemployment. Women go down 1/10. Average hourly earnings is interesting. Same as last month, 0.3% on a month-over-month basis, which was what was expected, but we do get a slight decline in terms of the year-over-year to 3.8%. And federal jobs, which is the number everybody wanted to know, they're only half of what they were last time in terms of jobs lost. 3,200. Add in postal workers, you get 4,000. They were 7,000 in the month of February. So the Doge effect has not taken effect yet. All this leaves the markets thinking we're still going to get 4 rate cuts by the end of the year. Earlier today, we were closer to 5, and now that's come down some. Let's see what happens as the day goes on.
So, Mike, heading into this report and in the aftermath, it seems like a lot of folks are calling this basically a sideshow. This isn't the focus right now, even though this is the most recent read that we have on the labor market. But it's all about tariffs. And we actually are going to hear from Fed Chair Jerome Powell in the 11 a.m. hour today. How candid do you think he will be?
I think he will be as candid as he always is. In other words, you're not going to walk away from his remarks this afternoon knowing anything more about what the Fed's going to do, because they're going to say they don't know what to do. Now, what you can take away from this report today is that the labor market is still solid in the way the Fed has put it. Unemployment, the slight rise to 4.2%, meaningless. So you're looking at a 4.2% unemployment rate. You're looking at still reasonably steady wage gains, but they can say they came down year over year, so there's not a lot of inflation pressure there. Fed has two mandates, employment and inflation. And with these employment numbers, the Fed's going to be able to say we can focus on inflation for the moment, and let's see what happens because of the tariffs in terms of prices.
All right, Mike, looking forward to hearing from the horse himself. That is Bloomberg's Mike McKee. The Fed also, of course, watching tariff impact on inflation. You have countries like China and Canada retaliating against Trump's trade war. The big headline, though, is what we heard from China this morning. But let's take a listen to what the president had to say yesterday about negotiations.
It depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff?
All right, Bloomberg trade czar Brendan Murray joins us now from London with the latest. So, of course, the message from the administration had been, don't retaliate, let's negotiate. But China clearly had its own plans.
Yeah, exactly. China wasted no time slapping the U.S. back with tariffs. And in addition, this could be an underhanded message to President Trump to say, yeah, we can hit you back too, but we should if you're up for talks, this is the time to do it, rather than further down the line when this thing escalates into a trade war that damages both economies. I'd point out that the tariffs are one thing, the 34% that China hit back with, but the export controls are also really crucial here. Those 7 rare earth minerals, without access to those, many American companies were going to have to shut down. And these go into things like precision medical equipment and car batteries, electric batteries. So that is one of the interesting elements here that could probably do more economic damage than the tariffs on U.S. exports to China themselves.
All right, Brendan, thanks very much. Brendan Murray there covers global trade for us out of London. This trade war continues to wreak havoc on markets, and Wall Street is sending real signals about the sell-off. Let's listen in.
I think some great opportunities, great buying opportunities are being created here in the market. I mean, the U.S. still stands out in the realm of technology and communication services. The Magnificent Seven are quite unique to the United States.
On the other hand, PIMCO's Bill Gross says investors shouldn't buy the dip, saying this is a market event similar to the end of the gold standard. Let's get a deeper understanding of this dichotomy with Bloomberg The Close host Romaine Bostick, who joins us on set.
Hey, Matt, you kind of have to look at this from two angles, from the fundamental angle and, of course, also from the technical angle. On the fundamental angle, Ed Yardeni makes a good point here. Forward PEs right now on the S&P 500, the lowest that we've seen in more than a year, at least going back to the start of 2024. But, of course, there's a reason why they've dropped to where they are. Are you going to buy into a fundamental economic story, a fundamental corporate story? Okay, maybe so. But then there's the technical side of the equation. Two numbers I want you to keep your eye on, Matt, 53.58 and 53.20. Those are basically the main support lines on the S&P 500. Futures, they've been below that all day long. Remember, at around 7:30, we hit 52.10 on S&P futures. Now, not only putting the S&P 500 on pace for one of its worst weeks going back to 2022, but quite frankly, putting it on pace for the first time to fall below every key support level for the first time since the onset of the pandemic in March and April of 2020.
And sort of a narrative that kept getting bandied about yesterday. We heard this from Mike Wilson, that you take a look at what's happening right now, this sell-off, Romaine, and it doesn't seem like there's panic yet, but maybe that narrative is changing a little bit this morning. Matt and I were looking at the VIX hitting 45 at one point. There's some nervousness working its way through the credit markets as well. What are you hearing from investors when it comes to whether or not there's actually fear in this market?
Everyone keeps calling this an orderly sell-off. Now, Most of those people said that prior to what we saw happen overnight with the spike in the VIX. One interesting thing that I think is, to your point, Katie, is money rotating around within the market? Remember, a lot of the sell-offs we saw earlier in this year, it was more people going out of the more heavy-weighted stuff into sort of the lighter-weighted stuff, and that brought down the broader indices. You look at what's happening in the pre-market. Are people rotating into utilities? Are people rotating into consumer staples? Are people rotating to some of those other defensive sectors like they did yesterday and the day before? Sadly, the answer is no. When you look at the consumer staples space, really Mondelez right now is the only stock in that space that is higher. Most of the other things that are getting bid, you're going to see that in the treasury space. You're going to see that in gold and to a certain extent, foreign FX.
We saw a drop so serious yesterday that Bloomberg put a red box around the percentage decline. I mean, if you type WEI, you can see that really across the board. And if you look back, we have a chart 3387 in the library. If you look back at drops of 4.5% or more on the S&P, you only see them in COVID and during the great financial crisis.
Yeah, I mean, this is unprecedented. And we had a good debate. And it's not just academic, Matt. If you removed the COVID pandemic. So let's assume that was just a blip. Just assume that we're really talking about unprecedented moves in the market right now, that you would really have to go back to like the 1970s to see something like this. And what is the course correction? Is it monetary policy? Is it the White House and Trump just flipping the switch and saying, okay, oops, my bad? I don't know. Most of the people we spoke to yesterday on the close, they seem to think we've kind of went past that Rubicon already. So even if there is a flip back, there's going to be such a lag to repair what has been done to this market that we could be seeing red on the screen like this for quite some time.
And Romaine, we have to be out of here by 9:12 or so, but you mentioned that defensives did well yesterday. I just want to bring out
running the show?
What worked. We are, you are, Romaine. It was Lamb Weston, it was Philip Morris, French fries and cigarettes. There are still some spots that you can pick and choose in this market.
One of the best performing subsectors yesterday was managed healthcare stocks. And look, I mean, that's where people's minds are at right now. They're talking recession risk, and if you do believe we're headed towards a recession, you look for the things that people have to spend money on. In theory, healthcare and I guess French fries, at least if you're Matt Miller.
You still see, I mean, there are some winners in today's market.
Yeah.
Smucker's was one, Dr. Pepper was, anything that's basically addictive and horrible for you is going to be up today. Romaine Bostick, thanks very much. Really looking forward to the close today. This is one Friday where I will stay to the end of
Matt,
the market.
Thank you, bless you.
And
you are a national treasure.
No, because we've had flips, right? And yesterday I thought maybe we would see one again, but it just got worse into the close.
It got worse into the close, and like I said, a lot of key technical levels and fundamentals levels like Dardenne was talking about. Maybe that does bring people back into the market. Stay tuned.
Yeah, we'll have to see. We've certainly seen plenty of volatility. When it comes to the Friday session, that is Romaine Bostick. Tune into him at 3 p.m. But, Matt, it's interesting to take a look at this jobs report and think of the kind of non-reaction that we saw in futures to it.
Absolutely.
I mean, it's just, we haven't seen the full impact. Maybe you saw some Doge effects coming through, but the focus is really on tariffs and what the next several months, the next several quarters look like, not what happened in March.
I mean, the jobs report in itself, I thought if there's a big miss, right, it's going to be a big, huge problem for this market. And then our producer out of London, Dan Curtis, said, if we get a hot print, it's going to be a bloodbath, right? This is as hot a print as I could possibly imagine. 228 over expectations for 140. And we did have futures bounce back up a little bit, right? We were down more than 3% on S&P and Nasdaq futures before this report. So it remains to be seen how the market is going to read this jobs report. But I think, to your point specifically, it just doesn't matter. Right? They're looking straight through non-farm payrolls into the tariffs. Yeah, so Dan Curtis, we have the receipts, but let's discuss this jobs report with someone who has decades of experience in the market. That is BlackRock Chief Investment Officer of Global Fixed Income, Rick Rieder. Rick, it's great to have you with us. We speak to you every jobs report. And again, the narrative that's out there is that this one in particular is a little bit of a sideshow. So talk us through what fundamentally has changed for you since now and when we spoke to you about a month or two ago.
Thanks, guys. Thanks, Katie. I don't know, decades of experience. I don't know, that sounded daunting from an age perspective.
I wanted to make you sound like you have gravitas, Rick.
I understand. I appreciate that. Did we have a jobs report today? It is. This is one of the. This is one of those reports. Interesting, but I'm just writing a piece where I said next month's report is going to be very interesting. Listen, I mean, you can't write it off. I mean, when you look at it, you've got a jobs market, particularly the service sector, that just continues to hum along. I focused on healthcare and education, leisure and hospitality, pretty solid. And so what does it mean? I think, you're also going through this extraordinary sentiment shift. And looking what the data is going to be over the coming months are going to be fascinating. But, today's report, I always look at it, there's some interesting trends within it, but we're going to quickly forget about it.
One of the things I saw in the jobs report, I don't know how much it means, but manufacturing jobs added 1,000. The expectation was for 0. Rick, you are, I think it's safe to say, pretty well connected in the corporate world.
Yeah.
How many CEOs are telling you, well, I'm just going to move production back to the U.S. now? Who's doing that?
It's a great question. So listen, I think every CEO is evaluating their business, and I think today, virtually everyone I talk to and others talk with are suggesting, let's understand the landscape, let's figure out where we're going to be. And the truth is, you're not really going to know what the landscape looks like probably for another month or two. We've got to get what is the reaction function. Obviously, we heard from China. My guess is that's not the last discussion around China. So, today, I don't think I've ever seen in my career more of CEOs, CFOs, by the way, investors, and even some consumers say, I need to evaluate where we are. I think you will see, personally think you will see some manufacturers, some producers that'll say, gosh, the cost differential is significant. I will bring some of my operation back here. But I think the near term, people are sitting on their hands in epic proportion, and I think people want to see the news. See what the ultimate news is to make a tangible decision.
All right, Rick, we're going to keep you today through the opening bell. So Rick Rieder from BlackRock is going to stay with us. Coming up, Labor Secretary Lori Chavez-Deremer on the state of the jobs market. Is this the Trump economy now? This is Open Interest.
Live from New York City for our audience worldwide on Bloomberg TV and on Bloomberg Radio, I'm Jonathan Ferro, and joining us now, I'm very pleased to say, is the U.S. Labor Secretary, Lori Chavez-Deremer. Madam Secretary, welcome to the program, and first of all, congratulations on your confirmation. Secondly, the jobs report, a blowout jobs report, an upside surprise. There can be no debate about how solid this jobs report is this morning. Where there is debate on Wall Street, as I'm sure you know, is whether this will be the last solid jobs report for the remainder of 2025. There is a lot of worry about policy volatility. What gives you the faith, the hope that we will see more of the same?
Again, for having me. And listen, this is a great day for America. This is a great day for the American worker, and this is a great day for President Trump. I can tell you this, I don't expect that this will be the last positive jobs report. We're going to be on the ground. We're going to be working together. We're going to be focused on the American worker. We blew it out of the water today. And again, as I said, this is a great day for America.
With stocks down 2.5% for Wall Street, they'll struggle to say the same thing. We heard from JPMorgan in the last 24 hours who said there will be blood. Neil Dutter, Renaissance Macro, another well-known strategist on Wall Street, said it's Obliteration Day, not Liberation Day. Where are we going to get the confidence to hire in America with sentiment so beaten up over the past month?
Well, again, I don't believe that that's a sentiment across America when you're talking to the workforce. If we grow this economy, if we have positive job growth, people will start to keep more of their hard-earned dollars. They'll start to invest. They'll start to save. And I think you'll see those markets respond. Again, the president went around during the campaign, and he's keeping his promises to the American worker. He is the president of the American worker. We align on that. I'm going to be on the ground starting this weekend in Pennsylvania talking to the American worker. I want to know what they're doing, what they care about, and I will report and advise the president on the positivity there. And we're going to start to grow this economy as we build the workforce here in America, and we're going to see these numbers continue to rise.
We don't hear that same positivity. In a recent consumer sentiment survey, in fact, 2/3 expected unemployment to worsen through the remainder of the year, the highest reading going back to 2009. These are people who are anxious about their jobs, anxious about the labour market. You want to see a massive transformation. You want to see a huge shift, a reshoring of manufacturing. They're things a lot of people want to see. At the same time, we hear repeatedly that people are just sitting on their hands and waiting. Who's going to do the hiring?
Well, I can tell you this. The labor market is holding steady and we're growing. Unemployment is holding steady. The labor demand is growing. We're seeing that in our companies. We're seeing the investments by major companies, tens of billions, hundreds of billions of dollars, where the workforce, the American workforce, is going to grow. That is going to be the key for the president. It's going to be the key for me as the Department of Labor to protect these American workers first and grow this economy. That's what we're seeing across the board. So, yes, we will be hiring. We have to get out there and make sure that our workforce is skilled and trained. That's what I'll be focused on. You know, John, as a former mayor, as somebody on the ground, that matters most in all of these communities, where they are urban, suburban, or rural. And we want to make sure that we're supporting President Trump and his agenda, and that we're growing that workforce each and every day.
I think, Madam Secretary, a lot of people would have sympathy with the idea that a lot of manufacturing in America has been hollowed out over the past few decades because of globalization. They will certainly have sympathy with that. Where they will struggle is with the strategy for this week. When you see tariffs like 46% on Vietnam, when you see retailers get absolutely hammered, you can take a step back and just acknowledge that the weight differential between what you can earn in Vietnam and what you can earn in the United States is just too large, that those companies will have to accept the tariff, won't be able to move manufacturing back to the United States, and they'll have to do something about costs, which will damage the retailer on the ground on Main Street in America. It's the rollout of this strategy that people are really struggling with. Madam Secretary, how can you guarantee that these retailers won't just be laying people off and putting up prices? In what world are they going to move manufacturing from Vietnam and start making sneakers in the United States?
Well, I can tell you this. What we saw at the Rose Garden just 2 days ago was the president talking to the American worker. We saw who was in the audience. We saw the American worker there. Supporting President Trump. That's who he campaigned to. That's who he believes in. That's who I believe in. These companies are going to repatriate. They are going to onshore back to the United States. We want fair trade agreements for our American businesses here as well. That's what the president does best. I can tell you this. He is a master negotiator, and he can teach a master class in that. And I can tell you the people who were in that audience were excited. They were cheering him on, and they are supportive of that. I will continue that effort. I will be on the ground across this country to make sure that the president knows what's happening on the ground, and we can continue to have positive growth for those business owners who are on the ground, because I do understand that they put their blood, sweat, and tears into the businesses that they have, and the American worker as well. We're going to protect all of them.
They put their blood, sweat, and tears into the ground as well. The American farmer's got to confront this headline this morning that China's announcing an extra 34% tariff on U.S. goods. What's your message to them?
Well, our farmers and ranchers and producers deserve our attention as well. I'll be working with the Ag Secretary along with President Trump to make sure that they have the necessary things that they need to make sure that we are competitive on the world stage. America is number one. It will continue to be number one. And I'll do everything I can to support those farmers and ranchers and producers with the American workers and the workforce that they need to get the job done.
So we've got some key dates. April 5th, baseline tariffs go in. April 9th, the bigger tariffs go on. The day after, China threatens to retaliate. You're the face of the administration today. Are there any negotiations taking place this weekend at a high level between China and the United States?
Well, I would imagine the president is on. President Trump works nonstop. That is why he built a formidable team like myself and the rest of the secretaries to do our job and support him. We will continue to do so. I would imagine that the president is continuing to have these conversations because he wants to protect the American worker and the American business. We're going to make America wealthy again. You heard him say it, and I'm going to help him do it.
I hope you're right. There are doubts on Wall Street this morning, and you and I will talk again in the future, I'm sure, for an update. Madam Secretary, thank you for your time. The Labor Secretary, Lori Chavez-Deremer. Madam Secretary, thank you.
All right, thanks to John Farrow as well. Let's get a quick check on futures right now after that jobs report, which really blew away the estimates. We are still looking at 3% down on Nasdaq futures. Russell 2000 futures off another 4% after a 20+% drop from the November highs. Less than 4 minutes until the opening bell. BlackRock's Rick Rieder is still with us. This is Open Interest. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are off 2.5% after yesterday seeing the biggest drop in the cash trade in 5 years. Nasdaq futures down 2.8%. Russell 2000 futures, after the index has gone into an official bear market, down 22% from its high, off another 4%. So there will be blood, as JPMorgan's Bruce Kasman said in his note today. You can see RBC Capital Markets ringing the bell at the New York Stock Exchange today, celebrating a 31st anniversary of some hockey charity or something. Microsoft down at the Nasdaq celebrating their 50th anniversary, in a pretty scary reminder that I am older than Microsoft, Katie. So that doesn't matter today. All that matters is the sell-off we're seeing and in stocks and the buying that we're seeing in bonds.
Absolutely. Let's talk about the stocks first, because I want to take a look at the likes of Apple and Tesla, Alibaba, all linked to China. Remember, China added a 34% tariffs on all American imports starting on April 10th. That was announced earlier today. We just got a response from President Donald Trump on Truth Social posting that China played it wrong. They panicked. So not exactly a free-flowing negotiation just yet. You can see that those sell-offs that we saw materialize yesterday gaining steam today. Apple down 3%, Tesla not too far off, Alibaba down nearly 9%, Matt Miller.
All right, we are watching other sectors, including retailers. We see continued slide from Nike today after the company was decimated again yesterday, now down 4%. Energy also, as we see the underlying oil price absolutely crater, we see the energy producers drop as well. We're looking at NYMEX crude, by the way, under $62 a barrel right now, so Occidental is off. And then banks continue to fall. JPMorgan Chase is one here, but you can look really across the KBX and see that they're all down. JPMorgan off 6%, all deep in the red following that Chinese retaliation news. We're back with BlackRock's Rick Rieder. And Rick, let's dive into this trade war, which is kicking off. I guess the Trump administration put massive tariffs on China. China is striking back with massive tariffs on the U.S. How does this play out for our economy?
Listen, I mean, in the near term, and similar to what we talked about, there's a lot of discussion about recession. And, the way we define recession is interesting. You get a couple of quarters of negative growth. What I actually think is happening is you could have a downturn because of people sitting on their hands. That could be pretty intense over the short term. I don't think it's, quite frankly, I don't think the timing is at 2 quarters or 3 quarters or 1 quarter of softness. It's the intensity of how much do people sit on their hands for a while. So, listen, I think it's going to be, we're going to have a softer period. I think you have to build that into your asset allocation, how you run risk, because we're not going to know, at least for a few weeks, what the ultimate outcome is. When will corporate CEOs start to do more in CapEx, R&D, M&A? Well, my sense is it's going to take a few weeks for that to play out. But I think you have to build in any portfolio. There's going to be a soft patch.
All right, so you're saying a softer period, a soft patch. I want to go to a note that came out this morning from George Saravelos over at Deutsche Bank. He wrote that the market is doing one thing, pricing in a global recession. Rick, it sounds like you don't quite see that yet.
So, no, I see some significant slowdown in the near term. Like I say, whatever we call it or whatever we term it, I think you got to manage your risk. I talked about it last week, the week before. I think you got to pull back on risks that you take within portfolios. And I think you're going to see some tangible slowdown in terms of, what orders go through, how do companies think about their inventory development, how do they think about what cost of goods sold is going to be, what does it mean for margin, do you have to start to make some inventory adjustments, CapEx, people adjustments. So, listen, I think your portfolio has to reflect that there's going to be a weak period. And,
right.
The question of defining the durability of that, I'll say one thing that's very different when people think about spending. CapEx you put in place for 5 years, 10 years, sentiment can change amazingly quickly. And so we're in this period where sentiment now is going to be really tough. That can change. And so I think you got to think about, how do you position, what are the conditions that you'd operate in where sentiment, my sense is sentiment will change quite a bit, whether that's
right.
a month from now, 2 months from now, or 6 months from now. is going to be the key for markets.
Well, Rick, is that what you're doing? Because if I take a look at BINC, of course, that's your ETF. I see a 9.5% allocation to investment grade corporates. Then I see a nearly 38% allocation to high yield, which certainly we've seen some cracks start to form in the corporate credit market. Should we see some of those come down in coming days?
So I think if you study it, which you do, I think you'll see those having come down. But I will say one thing about, the one thing about positioning around, the things you do a week before, 2 weeks before tend to be your best, how you manage a portfolio. Increasing some of your interest rate exposure, bringing down some of the lower quality parts of your portfolio is definitely what we've been doing. And by the way, if you think about single B high yield in the U.S., double B in Europe and the U.S., that credit conditions should be okay. Managing that and putting some hedges around it, including some interest rate. If you look at performance of how a portfolio like this did versus the high yield market, that's why it holds up so well.
I look at all the enthusiasm that we had coming into this year, Rick, was about deregulation and tax cuts, right? And it doesn't seem like the M&A guys are seeing the kind of allowance that they were expecting. And then in terms of taxes, JPMorgan's Bruce Kasman says this tariff hit, a 22% all-around tariff on imported goods, represents the biggest tax hike the U.S. has seen since 1968. Even I wasn't born yet in 1968. That doesn't seem like it's great for animal spirits, especially when Republicans are also talking about actual tax increases.
Yeah, I was born before 68. So the one thing I will say, listen, I think I think I said this last week. I think the dynamic of we've gone from animal spirits to animals in hibernation, and that's where I think we are. I think it is literally just hold off and wait and see what all these things that play through. I think companies are going to have to make significant adjustments. If you're a multinational, how you think about your supply chain, how you think about your distribution function, how you think about assembly. I think all those things are going to change, and that's why we're in this period that I think is to make decisions to add a lot of bait or think about risk today. I just think you got to be conservative. I think, I think you got to hunker down for a bit of time here.
I was in a Bloomberg chat with some private equity companies yesterday, and their portfolio companies are not going to be able to relocate production into the U.S. and are going to have to essentially double prices. That just isn't going to work for so many manufacturers out there. Do you expect these tariffs to somehow go away?
So, Matt, the thing we were going through today that is fascinating. So there is a transition. So, it's all about elasticities and the reaction function. And so we were trying to think, well, what is nominal GDP? If you slow down real growth, do prices stay exceedingly high because you've got these tariffs? And so your nominal GDP stays high because you've got higher prices and higher inflation. My sense is that doesn't capture the elasticity around it, meaning what will happen is companies will have to reduce prices. You're seeing that in some of the retailers, more promotion, more couponing. So I think what will happen is companies, the first reaction function, I'm going to pass through price. Maybe I don't pass through all of it. I'll absorb some in a margin. I'll try and pass through some. My sense will be you won't be able to pass through that much, which will denigrate your ability to actually get that price, and you'll start to see prices come down. So I think what will happen is you'll see volumes come off, and then you'll start to see prices will have to come down, or you just won't sell the volume. You just won't move the inventory you need to move. And listen, there will be some, there's no question, there will be some manufacturing that will relocate. It just takes time.
Right.
There'll be some distribution chains that will change, no question about it, depending on how people respond. And so, companies are going to try and keep that margin up. I'll throw out one thing that's hugely important. They're going to move faster towards productivity, automation. How do you make your business more efficient in a bunch of different ways? And that's the next trade that I think you got to put on.
And I do want to point out we're keeping a close eye on Apple, down about 2.5%, actually falling below that $3 trillion threshold on market cap. So these superlatives coming in quickly. I do want to end by talking about treasuries, because clearly there has been an enormous bid into the bond market, Rick Rieder. You know that well. But you have seen some notes out there, some worries starting to form that if this really continues, this trade war, and this deepens and escalates, whatever word you want to use, that you could see international buyers of treasuries step back even more than they already have. We know that China's holdings have been going down. We know that Japan's holdings have been going down. But do you think that that's a chip that's potentially on the table here?
So, tough one. So, listen, I think that there's a series of timing things to all these things. You know, we've talked about, we love the front end of the yield curve. You're pricing in a lot of cuts today. We've been taking some of our duration further out the yield curve for a variety of reasons, what it means for notionals, et cetera. But I still think, and you know, we talked about, we've added some interest rate exposure, been pretty significant. The front end now has got some, you know, how do you think about the front end? How much can the Fed go if inflation is this high? But anyway, holding interest rate risk makes sense. The longer term paradigm is incredibly important. Part of why policy has to bring the debt down, part of why spending has to come down is exactly like you say. We've relied on international purchases of our treasuries for so long, and those countries, forget whatever retaliation is, those countries have to fund their own domestic. If your own domestic economy is going to slow, you've got to fund your own, you've got to issue debt in your own domicile. And that is a big deal. So yes, I think you have to be really sensitive to that. It's part of why we need to reduce spending in this country. We need to manage the debt stack in this country because it's too onerous.
All right, Rick, great having you on the program. Really appreciate you spending so much time with us. BlackRock's Rick Rieder, also the manager of Bank.
Yes,
an
yes.
ETF that Katie watches very closely.
Well, it's grown pretty mightily since its launching. But I do want to point out, I liked your question about animal spirits because they've been nowhere to be found. Rick said that this is animals in a hibernation sort of mode. Do you know what animals hibernate?
Bears.
Bears.
Yes. Very good point. All right, so hopefully they can stay away, but we're not far off of bear market territory, right? We're down, what, 15% now on the S&P from
Somewhere
the high?
close to that, yeah.
Getting very close to bear market territory in the Nasdaq, and of course we've seen it on the Russell 2000. Coming up, we're going to talk about pharma avoiding Trump tariffs, at least for now. We'll look at the sector and top calls next. This is Bloomberg.
Welcome back to Open Interest. You take a look at stocks 15 minutes after the bells ring. Losses deepening right now. The S&P 500 now down nearly 3.4%. We were already heading for the worst week since March 2020, and those losses just keep coming. We'll keep a close eye on that because you take a look across the indexes, the Nasdaq 100 down a similar amount, and the Russell 2000 really bearing the brunt of the sell-off. This index already in a bear market, and it's just getting worse. Now down about 4.5%, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, one of Wall Street's most bearish Tesla analysts is getting even more bearish. JPMorgan's Ryan Brinkman is cutting estimates for the EV maker's earnings, citing unprecedented brand damage thanks to the Elon Musk backlash. Next up, we have Citi downgrading Kraft Heinz to a sell ahead of its earnings. The analyst citing growth struggles and margin risk. And finally, car parts retailer Genuine Parts getting upgraded to a buy over at Evercore ISI thanks to its insulation from tariffs. The analyst says that earnings may move higher actually because of tariffs. The stock right now is unchanged. I also want to take a closer look at pharma stocks. That's after the industry survived any sector-specific tariffs in Wednesday's announcement. But President Trump yesterday told reporters that tariffs may be coming soon.
The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals. It's a separate category. And we'll be announcing that sometime in the near future, not too distant future. That's under review right now.
Let's get some analysis now from Emily Field. She is head of European pharmaceutical research over at Barclays. Emily, it's great to speak with you again. And just set the scene for us. Any supply chain in any sector is going to be difficult to untangle from how globalized they actually are. But that feels especially dramatic when you think about the pharma industry.
Yeah, and I think what is just such a sweeping change for us looking at pharma on the investment side is just that as President Trump said, unprecedented territory. Pharma has been essentially immune from tariffs due to a WTO agreement from 1994. So it's just something that we have never even thought we'd ever have to consider. And now, obviously, it sounds like this is coming down the road. We're trying to do the analysis and have sought guidance from all of our companies. But, we're still at very sort of high level thinking about the impacts as it's so difficult to quantify.
How hard is it? I mean, I know that we have some workers coming back to the Health and Human Services. Maybe the FDA doesn't lose nearly as much staff as we feared, but there's still going to be a slimmed down workforce. How hard does that make it for drug companies to get things through and to get new advancements out to the public that needs them?
Yeah, that is a super salient point. And to be honest, me personally, that's what I'm more concerned about impacting the space rather than tariffs. Pharma products are still going to get made. These companies have very, very high gross margins, so they can absorb some cost increases. However, this is totally unprecedented at FDA. High level people at the organization that investors know about have left in the last week. Will this delay drug approvals? To be honest, we just do not know.
And I want to talk a little bit about specific companies. Novo Nordisk obviously is in your coverage universe. Novo having a really difficult start to the year, down 28%. And you think about Novo with its blockbuster obesity drugs, its biggest market is the U.S. I mean, when you think about the global impact of any specific sector tariffs here, I have to imagine that Novo could be in for more pain, Emily.
Yeah, and it certainly has been a painful period for Novo shares. And I think, it is getting sort of isolated as a potential tariff loser, if you will, given we know the supply chain because it's really centered on one drug. They make the raw semaglutide mostly in Denmark, although the filling and finishing is done elsewhere. And then, of course, Greenland, which is part of Denmark, seems to be in the headlines. However, what we're really looking for with Novo is, will obesity prescriptions start to rebound after the phenomenon of compounding, what Hims and Hers is doing in the U.S., is set to expire at the end of May? So that could be what we're all looking for as a potential turning point.
In your coverage universe, Emily, how much production is moving back to the U.S.? How many companies that you cover are saying, all right, in order to avoid tariffs, I'm going to bring all my drug production back to the United States of America?
Well, in terms of what we've seen from companies thus far, Johnson & Johnson, Eli Lilly, and Merck have, issued press releases saying, we're doing this incremental capital investment in the United States. None of the ex-U.S. companies have done that yet, although maybe that happens in the future. But the thing with pharma production is they're very, very long lead times to build facilities, and they're also highly regulated. So, you have to have some certainty on how long this tariff picture is going to play out. And then also, you're going to need FDA inspectors to inspect any new facilities that you're building. So in terms of where CapEx goes, that's still just another huge question mark.
And Emily, it's interesting how grim things feel in this industry right now relative to mid-January. I was out at the JPMorgan Healthcare Conference in San Francisco, and one of the big themes was we're going to see all of this M&A, we're going to see this merger activity, some consolidation in the space, all of those tailwinds that were kind of anticipated at the beginning of the Trump administration. It just feels like they've totally gone by the wayside.
Yeah, absolutely. And we were certainly expecting with the change at FTC, we know FTC had taken a pretty draconian view towards pharma consolidation under the Biden administration. All our large cap companies have very healthy balance sheets. We were expecting really significant M&A to pick up in 2025. But I think the uncertainty created not only with tariffs, but also with what's going on with healthcare policy under RFK Jr. at HHS, I think has led all these companies to just really sit tight and see what happens. We actually, given the policy overhang, downgraded pharma to neutral back in January, right after JPMorgan, as we thought this policy uncertainty would be a drag probably until about the summer.
All right. Emily, thanks so much for joining us. Emily Field there from Barclays talking to us about what to expect in the pharma industry. Let's get a quick check on stocks as the S&P, the Nasdaq, and the Russell 2000 continue to fall. We're looking at a 3% drop for the S&P right now, so not nearly as bad as what we saw yesterday, but it does look like if we stay at these levels, we'll close out the week down 6%. For the S&P 500. The Russell 2000 in an official bear market now off about 25% from the high that it posted in November. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check of what's going on in stocks. We are down really across the board. The S&P 500 is off more than 3%. So it is now off 15% from its peak at the end of February. The Nasdaq down 3% as well. The Russell 2000 has lost fully a quarter of its value, 25% from its recent high. In terms of the individual movers, Nvidia down 4.33%. You know that's a big heavyweight drag on the indexes. Apple is now worth less than $3 trillion. We have losers in DuPont, in Alibaba, Tesla leading the automakers down, but Stellantis is not far behind it with 6% drops at these two automakers. It is not a bloodbath. We're not looking at panic, Katie, but at one point this morning it did feel like we were going to be.
Yeah, absolutely. I mean, you think about the VIX hitting 45 on an intraday basis. That's only the highest level since about this past summer. But if you take a look at closing bases, then you have to pull out to a 5-year chart. So maybe it's not panic yet, but some of the measures that we were told to watch, it's the VIX, it's credit spreads, they're starting to get a little bit hairy. So not panic yet, and it'll be interesting to hear from Jerome Powell himself in the 11 a.m. hour, though there's a lot of questions out there about whether Fed policy can really offset the economic hit that might be coming.
Yeah, we'll talk about that economic hit with Claudia Sahm. She joins us in the next hour. This is Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is on assignment. And coming up on Open Interest, the carnage continues. Stocks plunge as President Trump doubles down and blasts China for retaliating against his sweeping tariff plan. A strong labor data print did little to mitigate anxiety about the impact of the trade war. Fed Chair Jerome Powell takes stage next hour. And Wall Street rips up its playbook. We'll hear from billionaire Howard Marks of Oaktree Capital today on Open Interest. All that and more coming up. Let's get a check on these markets right now. As I said, carnage. You can see the S&P 500 down 2.8%. We're off the lowest levels of the session, but still shaping up to be the worst week since March 2020. Take a look at the Nasdaq 100. Big tech has really been in the crosshairs of a lot of this damage, down about 2.7%. There's still a bid coming into the bond market, but it's been lessening throughout the morning. But nevertheless, the 10-year Treasury yield right now still below 4%, Matt Miller, a bid of about 8 basis points, bringing the yield down.
Yeah, I'm really looking forward to that Howard Marks interview because he's a distressed debt investor, right? And every time in recent memory that we talked to him, he says things aren't bad enough to buy, but I wonder if now is the time. And I think a lot of viewers are wondering the same thing. Is it time to buy? Let's talk a little bit about the economy, though. Keep it separate in some ways from the markets. Claudia Sahm joins us, chief economist at New Century Advisors. She's a former economist for the Federal Reserve. She developed, obviously, the Sahm rule that we talk about all the time, helping us to identify the beginnings of a recession. Claudia, I wonder if you're looking at a recession now because of the tariffs. And of course, we got good jobs numbers out, but the unemployment rate ticked up a little bit. How do you think economists are viewing what we're seeing happening right now from the White House?
Right, so I think this past week with the announcement of tariffs that take us up to 100-year levels of tariffs, if those go in place and stay in place for any period of time, it will be very difficult for the U.S. economy to avoid a recession. Now, we're not in a recession now, and I think, today's employment report tells us, we've got some resilience, we've got some good news on our side, but we are talking about what is essentially a major tax increase that will be hitting the U.S. economy very quickly, and that's a lot for us to buffer. So the recession concerns are more about as we go further into this year than about this moment in time.
I want to get your thoughts on stagflation, because in addition to recession, we're hearing more and more about stagflation. There was a really interesting note out from Ian Lingen over at BMO saying that it's difficult not to have a stagflation light scenario as our departure point. Claudia, what's your take?
I would agree with that. And to be clear on the term, we are likely to see inflation move up, right? So the CPI release next week, that's probably going to be the best one we get for a while, right? And so with the tariffs going into place, the price level will move up. We'll see inflation go up. Then there's, at the same time, it's a hit, it's a tax, taking away disposable income, and you're going to see growth slow. So that's the stagflationary impulse we talk about. We shouldn't think back to the 70s, double-digit unemployment, double-digit inflation. That is not what we are facing. But it's a very tricky situation where you're getting hit on both sides in terms of less growth, less employment, and more inflation. Now, I think the inflation piece, as prices adjust to the tariff, and there will be some rounds of retaliation, but that should dissipate to some extent. I think that's probably why the growth effects, this recession scare, is getting more attention. I think that's probably the right framework given the policies that we're grappling with.
Now, JPMorgan, Bruce Kasman over at JPMorgan says this basically 22% tariff is like a tax the size of which we haven't seen since 1968, worth almost 2.5% of GDP. If you raise taxes that much, Claudia, I can't understand why it wouldn't be something like we've seen in the 70s.
Well, I don't want to. We can draw lessons from past decades, but I do think it's probably worth focusing on exactly what the shock is that's coming at us. I mean, this is very serious, and again, it depends. The path forward depends so much on what these policies actually look like 6 months from now. The tariff policies, have they gone into effect? Have they been negotiated down? So there's a lot of question marks about what we're headed towards. The one thing that I would add in terms of this tax increase is tariffs create the worst kind of tax increase because they hit lower income families the hardest as a proportion of their income. So we are really going to, it's going to be a big tax increase across the board, but it's hitting those who have the hardest time buffering these kind of shortfalls in their income.
And Claudia, I just have been wondering this morning whether the genie is out of the bottle. There's this idea that's still out there that, Donald Trump is using these tariffs as negotiation tactics to basically bring other countries to the table. So far, it seems like we've mostly seen retaliatory measures from the likes of China comes to mind just this morning, and France. But do you think that even if we did see some movement, that maybe if these tariffs didn't stay on for months, but only weeks, what would the overall hit be?
Right. Well, again, this goes back to where the starting point is very important, right? We have an economy that is still in a solid place, right? And that was affirmed today with the jobs data. So you've got a continuum of things are going to slow down some. Are they going to stagnate, or are we going to contract, right? So it does, the magnitude of these tariffs, and there are other policies that put in place. Also talk about the federal government downsizing and the immigration, right? There's multiple anti-growth policies that the White House is pursuing, and the details matter and the magnitudes matter in terms of what it looks like. I mean, none of this is pointed in a good direction for this year, but avoiding a recession, which once you get a dynamic going to the downside, it can really pick up momentum in the worst way. And we don't want to get in that situation, but we are certainly pointed towards it.
I will point out that Cambodia has agreed to lower tariffs. The president on Wednesday, when talking about Cambodia, said they've made so much money on us, and now they're going to lower their tariffs on some U.S. imports to 5% from 35%. So I guess that's headed in the right direction.
Cambodia came to the table.
That's right. Bank of America says it's the biggest shock to global trade in modern times. Is this really a sea change event, Claudia? Do you look at it like that?
Absolutely. I mean, this is a massive departure from the way that past administrations of the United States has approached trade, and not just for the last 10 years. We are talking generational shift in how we think about trade and whether it's a good thing for the U.S. or not. So, and this happened very quickly. right? So this is a big change. We're given very little time to adjust to it. And because of the magnitude of the change and how far off it is out of the playbook, there's a lot of uncertainty about what comes next. I mean, the thin silver lining here is this is a shock that is being driven by U.S. policymakers. We can change the policy.
Right.
Right. So, but you know, there's a lot of goals here, and these are elected officials. I'm not saying, but like, this is different than a lot of other recessions that we have faced down.
And Claudia, we don't have much time, but I do want to get your thoughts on the global economy before we go. I mean, the cliche we returned to yesterday was that the U.S. sneezes, the world catches a cold. When you think about sort of this self-inflicted economic hit that the U.S. is undertaking, what does that mean for the rest of the world?
Well, it's not good. I mean, the U.S. consumer is the powerhouse of the U.S. economy, but the U.S. consumer is also extremely important to the global economy. And so, you know, and the fact that we have been, like, we're tied in this together. So this is not good for other countries. This is not good for the U.S. And then, I think the bigger question will be over the long term, where the winners and losers of this policy come from.
All right, Claudia, really great to get some time with you on this Jobs Day. That is Claudia Sahm of New Century Advisors. Meanwhile, markets continuing to sell off right now. The S&P 500 down by more than 3%. Let's take a look now with Bloomberg's Denitsa Seikova. It's pretty ugly out there.
Yeah, it's actually one of the few times we see such a clear theme across assets that really wasn't evident a few days ago. Deutsche Bank, Bruce Kassman, the theme is a global recession. And we're seeing that trade in oil. Oil has stumbled 13% in the last 3 days. We're seeing in credit spreads, insurance against defaults jumped by the most since 2023. We're seeing it in bank stocks. The index is down about 5%. We're seeing it in the VIX. It's really a cross-asset signal that investors are worried indeed about a global recession. And earlier we had that narrative about Europe, we had narrative about US and the rest of the world, and it seems like markets are slowly pricing in really a global recession as European indices are also falling into correction and also feeling a lot of pressure. So this is no longer a US isolated damage to the market.
Are we seeing anyone, and I heard this morning on Tom Keene's Bloomberg surveillance, Danny Blanchflower saying, don't go out and try and catch falling knives. I think exactly. Bill Gross said the same thing.
Denitsa spoke to him.
Yeah, we spoke to him. And
But are you seeing anyone do that? Because to me, S&P 5200, like if you're in this market longer term, this is when you do buy.
Matt's
you want to buy when there's blood on the streets,
account
right?
Open right now on your screen.
He's buying. Well, we heard that thesis. It's interesting because we spoke to a few people yesterday who was like, oh, this is a buying opportunity. This is the level I see. And we're already below that level. So it's a very risky, it's just like with the rally, people were like, the momentum is so strong on the upside, you don't want to short it. And now we really see that very strong momentum. Obviously, people are interested in getting those positions. The Nasdaq is down so much. It's really an appetite entry point, but it's really hard because we have that technical selling, we have the volatility target funds, the CTA, the leverage funds.
Yeah.
So
if you don't want to sell at high prices and you don't want to buy at low prices, what are you even doing in this market?
You're in cash and you're earning about 4%. I will say when it comes to levels, we keep coming back to Nick Colas from DataTrack saying that fair value on the S&P 500 is near 4,900.
4,900, he said.
Or thereabouts. 5,200 isn't that far away. But I want to talk about some of those fund complexes you mentioned, because the VIX getting to 45, we actually now have volatility sort of tracking ETFs back in this market. They had a pretty ugly departure back in, I think it was 2018 with Volmageddon, but it's going to be interesting to watch some of those products.
For sure. And also, like, VIX is a very interesting metric that is featured in a lot of the models of just a massive universe of systematic sellers, of systematic investors. And what we saw, for example, in August 2nd, when we saw that massive spike in VIX, we saw a lot of those people reducing positions just because they have volatility targeting of like 10%, and obviously a massive moves changes positions for a lot of them. As you said, we have a really big buildup in that short volatility trade as well. Everyone has been so used to cold markets, everyone's used to VIX below 20, and it seems like that regime is changing. It seems like there is a lot of pressure on the VIX, so there is a whole universe of investors that are changing their positions just based on, on that move.
All right, Denitsa, great to speak with you. That is Bloomberg's Denitsa Seikova. Watch her byline. She is covering everything that's going on in markets. And coming up, private equity firms plunged yesterday on Wednesday's tariff announcements. We'll take a look at what's happening under the surface of private markets with Jed Laskowitz. He is head of global private markets and customized solutions over at JPMorgan Asset Management. This is Open Interest.
Let's get now to high interest to look at what's making headlines around the world. China is retaliating against President Trump's latest tariffs with a number of measures, including levies on all American goods and export controls on rare earth minerals, dealing a fresh blow to global markets. China will impose a 34% tariff on all imports from the U.S. starting next Thursday. Last hour, Trump posted on Truth Social, quote, "China played it wrong. They panicked. The one thing they cannot afford to do." Gauges for credit risk are at the highest that they've been since the banking meltdown in 2023. The moves signaling how nervous investors are about Trump's sweeping tariffs. The most active CDS contracts in the world, the market CDX North American Investment Grade Index, jumped as much as 8.5 basis points to 75.7. And Republicans for higher tax rates. Bloomberg has learned that some members of the GOP are considering creating a new tax bracket for those earning over $1 million a year with a top rate of around 40% in order to offset the costs of their tax bill. That is a stark departure from decades of GOP opposition to tax hikes. Officials in President Trump's administration allies on Capitol Hill are beginning to draft a tax package with the hopes of passing it within the next few months. Katie?
All right, let's get back to these markets because shares of the biggest private equity firms plunged in the U.S. yesterday after President Trump's tariff announcements the day before. Ares and KKR both falling the most on record. Joining us now with a closer look at what's going on in the private markets is Jed Laskowitz. He is head of global private markets and customized solutions over at JPMorgan Asset Management. Jed, it's great to see you in person.
Great to be back.
So we've seen the reaction to these tariffs in the public markets, but there's a lot of question marks over what is going on underneath the hood in the private markets. You can see that expressed in the share prices there. Give us your perspective from where you sit on what this reaction has looked like.
Yeah, I mean, we're at peak levels of uncertainty right now, or at least it feels like that. The tariffs are much more than anyone had anticipated. And as we think about, and it's kind of on one hand, we're at peak levels of uncertainty. And on the other hand, well, maybe we did get some certainty and maybe we are going to live with these high tariff rates for a period of time. And now we have to see, well, what's on the other side of that? The Fed has a lot of room to cut rates. A lot of room to move. And I think now we're kind of waiting to see what's next. And if you look at the public market reaction, just to try to put it into perspective, if you look back at the last 45 years, the S&P 500 has had an average intra-year drop of 14%. On average, it drops 14% intra-year. In 34 out of those 45 years, the S&P ended the year positive. Now, we're at 9% right now. A globally diversified 60-40 is down less than 1% because bonds are playing a role again because rates are down and protecting with the 60-40. So I think we need to put the sell-off in perspective, although it's been incredibly acute when you look at peak to trough. But these pullbacks are somewhat normal.
And I mean, you make a good point that there is a silver lining in 60-40 to actually have bonds doing their job. But to bring it back to the private markets, I hear what you're saying, that we've been here before, but there's a new class of investors who have come into, especially private credit, over the last couple years. It's been such a hot space. And Matt, you keep talking about, CEOs talking to their portfolio companies about not being able to move manufacturing. And I just wonder, I mean, are we headed for a potential upset when you think about some of those private credit deals that have been made?
Yeah, we're seeing a few different things in private markets, and these have been unfolding for the past few years. I think first is institutional investors in particular and high net worth clients looking for assets that offer inflation protection and low volatility. And we're seeing that in assets like infrastructure investments and real estate. And if you think about infrastructure, the need for increased energy demand, and this is not just about an AI boom, it's about the electronification of basically everything, and essential services like electricity and heat, safety and reliability being the most important. So opportunities in continuing in infrastructure. And the energy transition, as you think about that part of the infrastructure market, this is not a political issue. It's a necessity for the United States to maintain their industry, their dominance in industry. So infrastructure assets offering low volatility and real estate. Now, we're at a point in real estate where you've already seen pullbacks of 25, 30, or 40% compared to equity markets that are still up 30% or more. And the themes we're seeing in real estate continue to be, there's a housing shortage in the U.S., industrial outdoor storage, right. The need for individuals want their goods fast. That's not going to change. So the themes we're seeing in real estate are continuing to persist. And these are on markets that are already down 20 or 30%.
I wonder if this isn't about your typical intra-year dip or even generational moves like AI, but once in 100-year shift in the way America operates, going from essentially a free market economy to a centrally planned economy with these kind of tariffs. I mean, it is not something that anyone is used to, and I think the concern about private markets is the opacity.
Yeah, I mean, that's true, but the private markets also offer a premium, and they offer a premium for that illiquidity, and they offer a premium for complexity. And I think you mentioned some of the challenges, and I think there are some challenges in the private equity market. You've got 6,000 private equity sponsors across the U.S. and Europe. $3 trillion of capital. Tens of thousands of portfolio companies. And if you look at last year, down rounds, later stage rounds, about 60% of later stage rounds were down rounds compared to early stage rounds, where there was about 15%. That was the widest spread in a decade. So that's also why you saw continuation funds and secondaries at levels 40, 50% higher than the prior year, something like $160 billion in secondary transaction last year. So there is a shift underway. I heard you talking in the last segment about distressed. That's going to create a good opportunity in the distressed market because these companies, many of them are great companies, but they will need funding for continued operation. So there are opportunities both in the return-seeking segment, which I would say kind of more stressed and distressed, but also in the diversifiers, real estate and infrastructure. And they should be added to that public 60-40.
Well, to your point on distress, we'll be hearing from Howard Marks in a little bit, so looking forward to that conversation. I do want to talk about access to privates. I think you probably planned for the fact that I was going to ask you about private credit ETFs. We saw the State Street Apollo ETFs start trading in late February. It's been interesting to watch it during this sell-off, though. I think 70% of its portfolio is in public equities. But when you think about, again, these new buyers trying to gain exposure to private credit, what is your current thinking on whether a suitable vehicle to do that is the ETF wrapper?
Yeah, I think you bring up a great point. There are a number of vehicles that have become much more popular for private markets. Interval funds, tender offer funds, ETFs, and they present fantastic opportunities for individual investors to get access to private markets, but we have to make sure we're balancing those trade-offs of illiquidity in strategies that are daily valued like an ETF and daily traded. So I think this is much more about the intersection of public and private as opposed to private only. The majority of assets in many of these daily valued private strategies, are in public assets, and that's the way we expect the ETF industry to unfold. They'll be much more public than private, but have a dose of private assets in them to create that return kicker, for investors.
So a pure play private credit ETF, it sounds like you're saying that's either far off or maybe something that's just not going to happen.
I mean, I think right now there'd be some regulatory challenges to a 100% private credit ETF. But I do think that the opportunity set actually is much more across both that public-private spectrum. And when you get in a situation like we're in now, where you're seeing credit spreads widen, there are going to be great market-driven opportunities in public markets that you might want to take advantage of, in addition to things you might want to do on the public side. So we think about it much more as that intersection of public-private, and that's true for equities too. There are different periods of time where you see valuations in public and private equities, and you right now you're starting to be able to get public growth equities at much better valuations. You've been able to do that in the private markets for a long period of time.
Jed, you have a big job at JPMorgan Asset Management. What are the clients that you've spoken with, or the companies that you've spoken with over the last 48 hours said to you about this tariff regime change?
Yeah, I think people are trying to assess the impact. I know that sounds obvious, but I think a lot of our institutional investors have the luxury of longer time horizons, and they can take a step back and talk to us and talk to our experts about assessing the landscape. I think a number of our institutional and high net worth investors have been thinking about for some time, how do I get inflation protection in the portfolio? This idea of tariffs and being inflationary is not a new piece of information. The new piece of information is the level of tariffs. So,
right.
I talked about infrastructure at the beginning of the segment. That's an area where we see significant interest because of the inflationary protection.
Right. All right, Jed, it is great to get some time with you. I know it's been probably a very crazy week. That is Jed Laskowitz of JPMorgan Asset Management. The S&P 500 just hitting session lows, down about 3.8% at the moment. We'll continue to follow the action. All right, let's get a check on these markets, because no one is stepping in to catch this knife right now. The S&P 500 down by about 4% for the week. The S&P 500 has lost about 7%, on track for the worst weekly performance since March 2020. Not a superlative you want to see, and similar ones exist for the Nasdaq 100 and your big tech stocks, down about 4% at the moment. That bid into the bond market has been reignited in the past couple minutes. The 10-year Treasury yield now down 13 basis points. We're staring at 3.90 on your benchmark 10-year yield. Let's bring this conversation into the ETF world, because leveraged ETFs have tens of billions of dollars of U.S. equity exposure to dispose of. That's according to JPMorgan. The bank estimates that those products have to sell about $5 billion every time the market declines 1%, just in order to rebalance. Joining us now for a closer look, I'm pleased to say we have Bloomberg Intelligence ETF analyst Eric Balchunas. And Eric, I know you disagree with that estimate. Tell us why.
Yeah, because it doesn't take into account flows. And what you're seeing here is that, believe it or not, there's flows going into these leverage long ETFs. So that blunts a little of that. And the selling isn't really from the ETFs themselves as much as the hedging. So when you do a swap, these ETFs run on swaps. So the swap counterparty would have to short the stocks in order to keep neutral, right? So I do agree, though, that in general, if you look at the long-only ETFs, they're the bulk of the assets, but there's these funky leveraged in buffer products that sort of use options, and all of that creates like an amplification effect.
Right.
It's not that big compared to the size of the market, but it certainly is out there. And so, yeah, if the market goes down, these amplified kind of options using ETFs and swap using ETFs are going to add a little bit of downward pressure as well.
Right. Well, let's talk about that a little bit more, because you think about triple leverage Qs. Those ETFs have been around for a while, but some of the categories that you mentioned, especially leveraged single stock ETFs, this is the first real dramatic market test that these products have been put to. And I don't want to get too dramatic, but could we see some sort of blow up, some sort of accident happen with some of these really out there products?
Yeah, no, we always talk about how these products are susceptible to what we call a hard rain. And this is a pretty hard rain developing. And in 2020, many of them got washed out. 2022, a bunch of other ones got washed out. So far, so good, though. Like, if you look at yesterday, the worst one was down 32%. Now, I know that sounds bad, but I would want to see one over 50 before we put it on the radar. So I think we'd have to see like a 7% sort of limit down day probably to get anywhere near this. But if the compounding effect kicks in, some of these could go to like negative 90% very quickly or over. So that said, that is what attracts some of these degen retail traders to the area, because for every down 32% one, there's a mirror twin that's up 32%. So we're seeing elevated volume in this area as the traders try to play it both ways. They love this environment. But yeah, we could see a blow up.
Retail investors, I know, are asking themselves, do I buy this dip? Because I get so much email from viewers expressing that exact.
You're also asking that question.
Well, I mean, I'm asking it because so many people are writing in and saying, like, okay, there's blood on the streets, and this is when we're supposed to buy, right, Benjamin Graham? So do you see that in ETFs, Eric?
Absolutely. This is something that I always talk about. And I actually got a text from my college roommate yesterday. He says, what's the buzz at Bloomberg about tariffs? I'm sticking with my steady monthly investments into my Vanguard ETFs. So I taught him well, by the way. This is probably the text people are going to get if you're in this industry. We find that a lot of Vanguardian type investors, at some point in their lives, they just came to the conclusion that they cannot time the market. And if you feel like you cannot time the market and you are totally resigned to that fact, the only answer is to just keep dollar cost averaging into the market. So most of the Vanguardian crowd is doing just that. And there was an article on Bloomberg today. They're buying the VU, the Schwab ETFs. We call those the buy and holders. The trading crowd, though, a little spooked. You know, SPY saw some outflows. So there's this sort of bifurcated, the traders getting a little spooked, but the Vanguardian bid still looks pretty solid. And it looks solid through most of 2022. It looks solid through 2020. And Vanguard, believe it or not, took in money every month in 2008. So it will take a lot more, I think, before you shake them.
Yeah, it's just wild. You mentioned VU. That, of course, tracks the S&P 500. I look at what the leaderboard looks like for flows over the past week, though. I also see, in addition to some of those S&P 500 passive index tracking funds, I also see BIL. I see SGov. Those are very short-dated Treasury securities ETFs. So it seems like, in addition to just buying into the dip that we're seeing in the indexes, Eric, that also there's this still gravitation towards cash.
This is a great point and really important. What we find in these types of sell-offs is the Vanguardian crowd will continue to buy dips, and even some of the traders will, but a lot of times they want to buy some protection while they're at it. So we do see gold and cash-like ETFs punching way above their weight in flows this year. So they're buying protection as they buy the dip, which, again, you could argue is a sign of their nerves.
All right, Eric, great stuff as always. That is Eric Balchunas. Tune into ETF IQ every Monday at 12 p.m. Eastern. Me and Eric and Scarlet Fu talk about the ETF world. You can also read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETF IQ newsletter.
That's not Cats and Coins?
No, it's official now. But Eric was talking about dips to buy, and boy, do we have one in the Nasdaq 100, Matt Miller.
Yeah, I'm looking right now at the Nasdaq 100 from its highs at the end of the year, currently down 21.6. Sorry, I'm looking at the broader, the CCMP, down 21.66%. That's got 3,000 stocks in it. If you look at the Nasdaq 100, you're likely to see pretty much the same thing as the two track each other very closely. All I do is click into the chart and then annotate it. Right now, I'm looking at a drop of the Nasdaq 100, 20.1%.
Just amazing. You think about the biggest losers, NVIDIA, Apple, Broadcom right now, taking that index into a bear market, and coming up, markets continue to plummet as the tariff turmoil continues. We'll hear from Oaktree Capital co-chairman Howard Marks next. This is Open Interest on Bloomberg.
Welcome to our TV and radio audience worldwide. Let's get to Bloomberg's Lisa Abramowitz. She's sitting down with Howard Marks.
Thank you so much to our Bloomberg radio and TV audience. We are incredibly lucky right now to get a chance with a man on the 30th anniversary of the firm he co-founded, Oaktree Capital Management, which has since grown into the world's biggest distressed debt investor. Marks joined us on a day of turmoil after putting out a memo about a month ago where he wrote The bottom line is that credit presently offers a better deal than equities. Even at today's spreads, credit isn't a giveaway today, but it offers a healthy absolute returns and is fairly priced. Howard joins us right now. Howard, you wrote that a month ago. The world has changed. We have seen the market sell off. We have seen tariffs implemented that are the highest levels that we've seen going back 100 years. Does your thesis still hold?
The yields on credit are still very healthy. And in fact, credit yields a little more now than it did 6 weeks ago when I wrote that memo. Then high yield bonds, for example, were yielding around 7.2. Today, they're close to 8, which means they went down in price, producing a higher prospective return. Of course, the stock market is well down since then. I don't know, 15, 16, 17%. I haven't done the math yet. And it keeps moving. But, you know, obviously, the state of the world, which equity prices depend on, is completely in flux and has been radically changed. Most investors think for the worse. That's why prices are down. The question, of course, is whether they're down too much, just right, or not enough. And almost nobody can say.
How do you start to even measure something like a potential paradigm shift, like the tariffs that were announced earlier this week?
Well, first of all, of course, measure is the wrong word because that suggests some quantification, which is impossible. There's nothing to measure. But how do you gauge? How do you think about the changes? And, you know, this is the biggest change in the environment that I've seen probably in my career. You know, we've gone from free trade or world trade and globalization to this system which implies significant restrictions on trade in every direction and a step toward isolation for the United States. I believe that the last 80 years since World War II have been the best economic period in the history of mankind. And one of the major reasons was the growth of trade. And I think that we have truly had a rising tide that lifted all boats, and trade was a big part of that. And everybody in the audience should understand the role of trade. Every country, for example, does some things better and worse. And worldwide welfare is maximized when every country does the things it does best and cheapest, and then sells them to the countries that need them, which do other things and sell them to other people. That's how trade works. And, well, I don't know if it's politically correct, but the good news is that the Italians make the pasta and the Swiss make the watches. But if we stop world trade and the Swiss have to make their own pasta and the Italians have to make their own watches, the world will probably be, well, maybe arguably people in both countries will be a little worse off. That's what we're talking about here. And we should not underestimate the benefits that we've gotten from globalization. And among other things, there was a 25-year period, which I cited in one of my memos 10 years ago, in which the cost of durables in the U.S. went down by 40% in inflation-adjusted terms. That kept a lid on inflation here. It made goods available cheaply to all Americans. If we don't have world trade, we don't have that benefit. And, you know, the tariffs are designed to encourage production at home. But who could imagine that most things produced in the United States will be as cheap as they are coming from abroad? In other words, things will cost more.
If that's the case, does that mean that you see the inflationary regime as being something that is more persistent, or a reversal of what we saw, the disinflation of the globalization?
Well, I think so. There were financial benefits from globalization, including keeping a lid on inflation. And, you know, if we hadn't bought our TV sets and appliances from abroad in that 25-year period at declining prices, what would inflation have been? And the answer is considerably more, maybe not 2, but maybe 3, 4, 5. And so, tariffs are an increased cost. Somebody has to pay them. And, most people think the consumer will pay them. There's some possibility that the importer or the exporter will pay them, or the government of the exporting country. But it's an increased cost, the proceeds from which will go to the government. And, will society be better off as a result?
When you're measuring how to decide the risk and reward of given asset classes in this type of environment, that could go in a multitude of different ways. How do you understand where there's value, what a return is that would justify a risk at a time when, potentially you could get 7, 8%, 9% with credit? With stocks, they have delivered more than 10% for the past number of decades. But going forward?
I want to respond first to your last sentence. Stocks have delivered an average of 10% a year for the last 100 years, but not when the PE ratio was 19. And the PE ratio today is probably 19. The average return has been 16. So we can say that when the PE ratio averages 16, the return average is 10. But when the PE ratio is 19, my guess is, if you look at history, if you bought the S&P when the PE ratio was 19, historically you probably made, let's say, 1 to 6% a year, or 2 to 7% a year, something like that, but certainly not 10. And so, what you pay matters, and the price of the S&P is elevated relative to historic levels, so you shouldn't expect historic returns.
Whereas in credit, one of your arguments is you can expect to get that return because the default risk isn't as great as some of the excess spreads and what you're getting in all-in yields.
Well, with credit is a newfangled word for fixed income, or which was a newfangled word for bonds. In 1978, I was moved at Citibank from the equities department to the bond department. Nobody talked about fixed income or credit. But with debt or bonds or fixed income or credit, what you see is what you get. You can read on the piece of paper what the promised return is, and then the only thing you have to wonder about is, will I get it? That is to say, will the issuer default, or will they keep their promises? And by the way, they promise you interest, they promise you to pay your money back at the end, and if they don't keep the promise, they lose the company. So they have a lot of incentives to pay. I've been in non-investment grade credit for 47 years, and in our experience, roughly 99% of our issuers have paid as promised.
You've thrived during your 5-decade career, almost 5-decade career, during times of dislocation. Is this a time of dislocation to play or not to?
Well, it's a time of dislocation. Everybody has to judge for themselves whether the reduction in asset prices so far is right, inadequate, or excessive. If it's excessive, you should jump in with both feet. If it's inadequate, you should wait until things adjust further. And it's impossible to make that judgment qualitatively. You used the word measure before. I pushed back a little bit. There's no place you can look. There's no analysis you can do to determine whether today's asset prices are right for the environment ahead. Now, there never is. It's always conjecture. It's always guesswork. That's, in theory, why the greatest investors are great, because they make those judgments better than most people. It's excessively hard today because today we have no idea what the future is going to be. Normally, we think we know what's going to happen in the future. We normally assume the future will look mostly like the past. We extrapolate, and usually it works because the world doesn't change that much. But the world economy and the world order beyond economy, meaning geopolitics and international relationships, has been shook up like a snow globe by the events of the last days, and nobody knows what it's going to look like. Nobody knows. I dare say, if you tell me that what our rules will be 6 months ago, 6 months from now, I'll bet you're wrong. This is in flux. And if you think it's in flux, then by definition, you don't know what the future holds. And then even if you know what our country's going to do, and it's going to be that way 6 months from now, we don't know what other countries are going to do, what the ramifications will be. And so, I always inveigh against forecasting. I don't believe in macro forecasting, my own or other people's. And we know much less today than usual. Now, people who like to run their lives according to forecasts, they say, well, this is going to happen in the future, so I'm going to do this, and this is going to happen in the future, so I'm going to do that. What you really need, if you like to work with forecasts, is you need two things. Not just a forecast. You need the forecast, but you need an estimate of the probability that your forecast is correct. And today, whatever your forecast may be, you have to say, the probability that I'm right is lower than ever, because the probability that we know what the future is going to look like is lower than ever. And that's how I feel.
Is this a time to be fearful or greedy?
What you have to say, Bloomberg's offices, you have to think in terms of your neighbor. The department store.
Bloomingdale's.
Bloomingdale's just put everything on sale. Prices have come down for the S&P, 8% in the last 2 days, and much more in the last 6 weeks. It's on sale. That should encourage people to think about buying. Will they go down further? Nobody knows. Are the prices fair? Nobody knows. But everybody runs from the market when prices go down because they think it connotes risk. It's just stuff going on sale. And, of course, it takes, well, I was going to say a pro, but it takes a prescient pro, of which there aren't many, to know whether, as I keep saying, the discounts are adequate or appropriate. But certainly you have to look. And it doesn't make any sense to say, just a minute, I did X, Y, Z when the price was 100. Today the price is 90, so I'm going to boycott it. That doesn't make any sense on its face. You have to take a hard look.
Do you still think that the U.S. is the best place to invest?
I think it's probably still the best place, but it's less best than it used to be, because I think that, if you think about the things that made it the best place, one of them was the rule of law. That may be less the fact today. One of them was the predictability of outcomes. That may be less today. One of them was the worst thing about investing in the United States for many years has been our fiscal situation, our deficits and debts. And the U.S. has behaved like somebody who has a golden credit card where there's no credit limit and the bill never comes. So, of course, you can spend more than you make. And if somebody has a golden credit card, well, what would you do? Well, you might buy a nice car, but what the hell? You might as well buy all the cars because the bill's not going to come. And that's the way we've behaved. And that's the way Washington has spent money. But can the events of the recent days change that? Can they cause there to be a credit limit? Can they cause a bill to be presented at some point in time? And if the answer to either or both of those questions is yes, that's a real risk. If people don't like the dollar, don't like investing in the United States, don't want to hold an unlimited number of treasuries, if we just make people mad and say the U.S. is still a great credit, but I don't want to hold their debts because look how they're treating me, the fiscal situation will be very complicated.
Howard Marks, we have to leave it there. That was Oaktree Capital co-chairman Howard Marks. Thank you so much. Back to you.
All right, and our thanks, of course, to Lisa Abramowitz and Howard Marks of Oaktree Capital. While they were speaking, we watched losses continue on the S&P 500, at one point falling 5.2% in a single day on the S&P 500. Just a refresher, it's been a while. Circuit breakers kick in at a drawdown, an intraday drawdown of 7%. Then the market will be halted for at least 15 minutes. The last time we saw these level 1 triggers go into effect was March 18th, 2020. That is according to Barron's. So we're still a ways off there, but something to keep in mind. And Matt Miller, I just want to point to volume right now. Trading volume is off the charts. We are 110% above our 30-day average on the S&P 500. So traders really selling aggressively into the weekend.
Absolutely. And you see the VIX creeping back up over 40 right now at 42.55, as you saw there from bonds. Buying is in action there. So price up, yield down to the 10-year at 3.90. Stay with Bloomberg. About 30 minutes until Fed Chair Jerome Powell delivers a keynote. This is Bloomberg.